Okay, let's jump right into Dell Technologies Q3 results.
And right away, you see this strange disconnect. It's a real financial paradox.
What do you mean?
Well, on one hand, Dell actually missed Wall Street's revenue estimates. They posted $27.01 billion.
And the expectation was?
The expectation was a little higher, $27.13 billion. So, a small miss on that top line.
But on the other hand?
They absolutely crushed earnings per share. I mean, they delivered an adjusted EPS of $2.59.
Wow, and the estimate was just $2.47.
Exactly. And, investors, especially in tech, they really focus on that adjusted number. It gives you a much cleaner picture of how the actual business is running.
Right. So a revenue miss would normally spell trouble, but the stock, it soared 5% in extended trading. We have to unpack that. Why was the market so enthusiastic about a revenue miss?
It's pretty simple, actually. The market is betting big on the future of AI.
And Dell is a key
A
player.
crucial one. They're seen as a bellwether for the whole industry. I mean, they're one of the top vendors for systems built on NVIDIA's processors.
So when Dell does well in AI, it's a sign that companies are actually spending the money.
That's it. Investors basically looked right past the slight dip in traditional sales and focused completely on the AI engine.
So let's dig into the numbers that prove that pivot is real. The Infrastructure Solutions Group, or ISG, that's their data center business, right?
That's the strategic heart of the company right now. ISG revenue hit $14.1 billion,
This is a huge jump.
a very strong 24% increase year over year.
Mm.
But what's really impressive isn't just the growth, it's the profitability.
Okay, so how significant was that improvement?
ISG operating income grew 16% to $1.7 billion, and more importantly, profitability improved from the last quarter, landing at 12.4%.
So they're not just selling more hardware at thin margins.
No, not at all.
Yeah.
They are scaling their AI business efficiently. That 12.4% figure tells you this whole AI pivot is sustainable, and it's very, very lucrative.
Okay, that 24% ISG growth is big, but how do we know for sure this isn't just, a general server upgrade cycle? We need proof it's AI.
Oh, we have the hard proof.
Let's hear it.
Within that ISG group, the servers and networking revenue line, it saw a massive 37% annual increase,
37%.
reaching $10.1 billion.
Yeah.
That kind of growth rate is just explosive for a core hardware
It's
business.
an incredible velocity.
And here's the number that really defined the quarter for Wall Street. Specific AI server shipments.
How much of that?
They accounted for $5.6 billion of that total in Q3 alone.
Wow.
So that's not a promise of future business. That is a huge volume of high-value, complex AI systems going out the door right now.
$5.6 billion in one quarter. That really cements Dell as a major player. But what about the forward momentum? If they're shipping that much, I imagine the orders are just piling up.
They are. I think the demand signal is what shocked analysts the most.
Yeah.
Dell recorded an all-time high of $12.3 billion in AI server orders
Just in Q3.
just in Q3. And if you zoom out, that means they've pulled in $30 billion in AI server orders so far this year.
That volume has to create a massive backlog, which means future revenue is pretty much locked in. How big is that backlog now? It's huge. The confirmed AI backlog at the end of the quarter stands at $18.4 billion.
Okay.
And get this, that number, the $18.4 billion, it actually excludes a massive deal they announced later in November.
The one with Iron and Microsoft.
That's the one. For the new NVIDIA GB300 systems. The point is, the demand pipeline is still multiple times larger than even that enormous existing backlog.
Just astonishing scale. So let's talk about the customers. When we think about the biggest buyers of this kind of hardware, we usually think of the hyperscalers, right? Amazon, Google, Microsoft.
We do.
Is Dell winning those biggest accounts, or is their strategy different?
It's a very deliberately different customer mix, and this is really critical to understanding their position. Dell actually sells less to those giant hyperscalers.
Why is that?
They tend to build their own custom infrastructure or, work with integrators that bypass the big vendors.
So if it's not the biggest fish, who's driving all this demand?
Dell's sweet spot is with large enterprises, governments, and a group they call the neoclouds.
NeoCloud. Think of them as Tier 2 cloud providers. Companies like CoreWeave. They're specialized, focusing on high-performance compute and AI for specific markets.
So they're building their own massive AI clouds, just not on the scale of an Amazon or Google. Why are they choosing Dell for that?
The execs point to three things. First, their expertise in engineering these really complex, bespoke solutions. These AI clusters are incredibly difficult to design and cool.
Right. It's not just shipping a box. It's designing a whole system, often with liquid cooling and everything.
Exactly. The second advantage is their ability to deploy these things at massive scale and fast. And third is their global service.
Have boots on the ground.
Yep. Big companies and governments need that kind of support, and Dell is perfectly positioned to offer it. They provide the custom integration and long-term service these clients need.
That makes a lot of sense. So they're winning the business that needs that white glove custom service, not just the raw volume discounts the biggest players want.
Precisely. They're targeting the high-margin, high-complexity part of the market.
So we've established the AI server side of ISG is just on fire, but ISG also includes storage. How's that part of the business doing?
Storage tells, well, a much flatter, more traditional story. Storage revenue was $4.0 billion for the quarter.
And year over year.
It was actually down 1%.
Wow. That contrast is pretty stark. Servers and networking up 37%, driven by AI, while storage is basically flat.
It really gives you the context for that big earnings beat. The incredible performance of the AI server business is completely papering over the stagnation in storage and at the same time boosting overall profitability. ISG is not a uniform growth story. It's an AI story.
Okay, let's switch gears to the other half of Dell's business, the Client Solutions Group, or CSG. This is their traditional PC and laptop empire, which has been in a tough market. How did CSG do?
CSG revenue came in at $12.5 billion. It was, technically a slight miss, but it was still up a modest 3% year over year.
Which, considering the headwinds in that market, isn't too bad.
No, even modest growth is a win right now.
And CSG is split between commercial, so businesses, and consumer sales. Was that growth even?
Not at all. The commercial segment was the clear winner here. Commercial client revenue was $10.6 billion, and that grew 5% year over year.
And I think I read this is the fifth straight quarter of growth for commercial.
It is a very important stat. It shows you how sticky their enterprise relationships are. Even when companies are tightening their belts, that IT refresh cycle for small and medium businesses keeps going.
Right, Dell's core demographic.
Absolutely. Dell is really focused on capturing share in that high-value premium commercial space.
Okay, so what about the consumer side? That's where you'd expect spending cuts to hit the hardest.
And it did. The consumer side is still a challenge. Revenue there declined 7% year over year to $1.9 billion.
Oof.
But, and this is a key nuance the execs were highlighting, there's something interesting under the surface.
What's that?
An executive pointed out that despite that negative 7% number, the consumer segment actually saw a return to demand growth for the first time in 3 years.
Wait, how does that work? If the number is negative, how can demand be growing?
It's all about the comparison period. They sold less this quarter than they did during the inflated COVID-era sales from a few years back. That's the negative 7%.
Ah, okay.
But they saw more new orders this quarter compared to the last quarter. It's a signal that the consumer PC market might finally be starting to recover, even if the year-over-year numbers still look bad.
So to sum up CSG, they're focused on profitable commercial sales while waiting for the consumer rebound they think is just starting.
That's the reality of their non-AI business. But again, all of this, it really just takes a backseat to the forward guidance.
Right. This is where we shift from looking at mixed results in the past to just overwhelming confidence about the future. The guidance seemed to erase any concerns about Q3.
The guidance was simply explosive, a monumental leap of confidence, and it's all driven by fulfilling that AI backlog. They expect Q4 revenue to hit $31.5 billion at the midpoint.
Wait, what were analysts expecting?
Analysts were modeling $27.59 billion.
So that's nearly a $4 billion beat on their own forecasts.
It's a massive swing. That guidance implies a stunning 32% year-over-year growth rate for the fourth quarter. You don't forecast that unless you have extreme certainty about your orders and your supply chain.
And I'm guessing the profit forecast followed that same trend.
You bet. Q4 non-GAAP EPS is expected to be around $3.50. Analysts were only at $3.21. Dell is clearly signaling a spectacular end to the year.
So this momentum must have forced them to raise their full-year targets, too, especially for AI servers.
They raised everything. Full-year revenue is now guided to $111.7 billion. But the real headline grabber was the new guidance for AI server shipments.
I remember the old target was already ambitious, something like $20 billion.
They blew past that. They dramatically raised the full-year AI server shipment guidance to $25 billion.
A 25% lift on their AI sales forecast for the year. That's incredible.
Yes.
It confirms that AI is now the dominant growth engine of the entire company.
And it suggests they think this is more than just a short-term bubble. The executives are signaling this is a long-term strategic shift.
What are they saying about their long-term vision looking out towards, say, 2030?
They're extremely confident. They've laid out a long-term framework targeting 7-9% revenue growth and over 15% EPS growth through fiscal year 2030.
Right.
All of it built on this AI leadership.
And they're backing it up with returns to shareholders, which is always a good sign of confidence.
Precisely. In Q3 alone, they returned $1.6 billion to shareholders through buybacks and dividends. That shows you they believe this AI surge is both profitable and sustainable.
So what's the essential takeaway from all this? I mean, it seems pretty clear Dell is successfully making a massive strategic shift. They might have slightly missed on Q3 revenue, but nobody cares.
Nobody cares. That narrative has been completely replaced by their pivot to being an indispensable AI infrastructure provider. The record AI orders that jumped to a $25 billion yearly AI server forecast. That's driving the whole story now.
The Infrastructure Solutions Group is leading the charge, but we have to come back to that customer strategy you mentioned.
Right. They're achieving this staggering growth by focusing on enterprises, governments, and these neoclouds, while explicitly selling less to the giant hyperscalers like Google and Amazon.
The ones who are building their own complete stack, as the sources put it.
Exactly. So this raises a really important question for you to think about. If the majority of the truly massive multi-billion-dollar AI projects of the future end up being housed inside those giant hyperscalers, can the enterprise and neocloud markets alone sustain this incredible pace of growth for Dell all the way to 2030? Or will Dell eventually have to find a way to crack into that top tier to keep the numbers climbing?
A fascinating strategic question. Succeeding by focusing outside the biggest part of the market will leave you to think about whether the enterprise AI market has the sheer scale to meet Dell's soaring expectations. Thanks for joining us.